Did you see what just happened with gold? It did the one thing it always does right before silver goes absolutely vertical. Gold moved first. It's been calm, confident, relentless. Just grinding higher, day after day, week after week, shattering resistance levels like they were made of glass. This isn't just another speculative trade. Gold is acting like a true strategic asset, a real alternative to reserve currencies, almost like the new anchor of a global monetary system that's clearly shifting under our feet. And the way gold is behaving right now is critical, because it's sending a massive signal about what's coming next for silver. Now, did silver follow along politely? Did it rise in perfect lockstep with gold? No, not at all. Instead, silver hesitated. It twitched, it got compressed, it lagged behind. And this very specific pattern, gold leading the way, while silver coils up like a spring, is far more important than most people realize. Because historically, this is the exact pattern that precedes silver's most violent, most explosive moves upward. You have to understand, silver does not move like gold. It doesn't do smooth, gradual trends. Silver doesn't just climb, it snaps, it explodes. Sometimes, it feels like it just teleports to a new price level overnight. When that coiled spring finally releases, the speed of the move shocks everyone, even the people who were convinced it was going to happen. It's always faster and more aggressive than you think. Our brains are naturally wired for linear thinking. We see a trend, and we expect it to continue in a straight, predictable line. We expect gradual change, but silver completely ignores our linear assumptions. Silver is pure financial chaos. It's leverage. It's the market's ultimate mechanism for punishing the consensus and rewarding those who got into position early, before the fireworks started. This brings us to a scenario that most people would immediately dismiss as impossible: silver hitting $100. Not in months or years, but potentially in a matter of days. Now, this isn't about hype or wishful thinking. It's about understanding the market mechanics that are already in motion, right now. Think about the gold to silver ratio. Historically, when this ratio gets stretched to extremes, like it is now, it doesn't just correct. It snaps back violently, a reversion to its historical mean of, say, 40-1, with gold at its current levels, would mathematically place silver well above $50. But what if gold continues its run to $2,500 or even $3,000? The math gets absolutely insane. A snapback in the ratio from those levels doesn't just point to $50 silver. It points to $70, $80, or even $100 silver. And then there's the short squeeze potential. The silver market is notoriously tight, with a huge, concentrated short position held by a few large banks. For years, this has acted as a lid on the price. But what happens when the physical demand from industry, investors, and even central banks overwhelms the paper supply? What happens when those shorts are forced to cover their positions in a panic? They won't be buying back their shorts in a calm, orderly market. They'll be buying into a market that's already rocketing higher, driven by gold's momentum. This isn't just fuel for the fire. It's like pouring gasoline on an inferno. When you combine a historic gold breakout, a dangerously stretched gold to silver ratio, and the potential for the mother of all short squeezes, you don't get a linear price move. You get a phase transition. You get a situation where the price has to re-rate almost instantly to reflect a new reality. This is how you can get a move from $30 to $100, so fast it leaves the entire world breathless. Look, this isn't a prediction carved in stone. It's a framework. It's an explanation of a path that exists if the current conditions continue to develop. And right now, every single one of those conditions is not only in place, but accelerating. Gold has fired the starting gun. The silver spring is coiled tighter than ever. The question isn't asterisk if asterisk it will uncoil, but asterisk when asterisk and whether you'll be positioned for it when it does. Thanks for watching, and don't forget to follow for more updates on this developing story. What's the biggest lie you've been told about silver? That it's boring. That it's just gold's little brother. Slow and steady. Nothing could be further from the truth. If gold is a giant, powerful battleship, trending deliberately over months and years, then silver is a speedboat strapped with a nitrous tank. It drifts, sits idle, and frustrates you for what feels like an eternity. And then, without warning, it detonates. It unleashes these explosive bursts that are so fast, so violent, that if you weren't already on board, you're left standing on the dock, just watching it disappear over the horizon. Why does silver behave like this? Why the Jekyll and Hyde personality? The secret is its size. The entire tradable silver market, everything, all the physical bars, the coins, the ETFs, the deliverable inventory sitting in vaults is worth roughly $50 billion. Now, $50 billion sounds like a lot of money, right? But in the world of global finance, it's a rounding error. It's smaller than many individual tech stocks. Think about that for a second. A single company can have a market cap larger than the entire investable silver market. This is the key to understanding silver's explosive potential. All it takes is a tiny shift from a few large players. Imagine one institutional fund decides to allocate just a fraction of a percent of its portfolio into physical silver. Or one sovereign nation decides it wants to bolster its reserves with hard assets and starts demanding physical delivery. Any one of these events is enough to send shockwaves through this tiny market. It's like dropping a boulder into a bathtub. The water doesn't just rise, it violently sloshes over the sides. That's what we call massive price displacement. When a big player comes in, they aren't looking to buy a few thousand ounces. They're looking for millions. And in a market this thin, that kind of demand instantly overwhelms the available supply. The sellers who were willing to part with their silver at the current price get bought out in an instant. The next tier of sellers are holding out for a much higher price, and the price has to jump or gap up to meet them. This isn't a gradual, orderly climb. It's a series of sudden, chaotic leaps. This brings us to a very important number, $100. Why is $100 silver the target that everyone talks about? It's not just an arbitrary round number. $100 is a psychological trigger. It is the point where silver stops being a niche asset for a small group of dedicated investors and blasts onto the front page of every financial news network. Markets, at their core, are driven by narratives, not just spreadsheets and fundamentals. And the headline, saying dollar to silver, is a narrative that spreads like wildfire. Think about the psychology. At $30 or $40 an ounce, people debate the pros and cons. They analyze the industrial demand versus investment demand. They wonder if it's the right time to buy. But when the price starts rocketing towards 100, the conversation changes completely. The question is no longer should I buy? It's am I too late? That shift from analytical caution to emotional urgency creates the most powerful force in any market. FOMO, the fear of missing out. And in a market as razor thin as silver, FOMO is like pouring gasoline on a fire. The available liquidity evaporates. Anyone who is thinking about selling decides to wait, thinking, if it's going to 100, maybe it's going to 200. So, sellers step back from the market. At the same time, a flood of new buyers, driven by FOMO, rushes in. They don't care about the price. They just want to get in before it's too late. What happens when you have a surge of desperate buyers and almost no sellers? The price doesn't just rise, it gaps. It jumps violently from one level to the next, leaving huge spaces on the price chart. This is the true nature of silver. It's not a slow, steady grind. It's long periods of quiet, followed by moments of pure chaos. We saw this pattern in the late 1970s. We saw it again in 2011, when silver went from $17 to nearly $50 in just a few months. In both cases, the move was vertical. It was a panic. Those who were already positioned made life-changing returns. Those who waited for confirmation were left behind. The fundamental drivers are all aligning for another one of these moves. Industrial demand is soaring, driven by the green energy transition. Solar panels, electric vehicles, they all need silver. And demand is they will pay whatever price is necessary to secure supply. At the same time, investment demand is waking up as people lose faith in fiat currencies and look for real, tangible stores of value. The supply side is struggling to keep up. Mines are aging, discovery rates are falling, and it takes years to bring a new mine online. So you have inelastic industrial demand, growing investment demand, and a constrained supply, all within a market that is comically small. It's the perfect storm. The pressure is building beneath the surface. And when it finally breaks, the move will be fast and it will be unforgiving. The path from its current price to $100 and beyond won't be a smooth, straight line. It will be a series of explosive gaps. The time to get your speedboat ready isn't when you see the storm on the horizon. It's now, while the water is still calm. Because once the engine fires up, you won't have time to react. Thanks for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the markets. Let me know your price target for silver in the comments below. See you next time. Let's not talk about fear, greed, or hype. Instead, let's look at this purely from a mechanical perspective. What are the gears and levers doing behind the scenes in the precious metals market? First, and most importantly, gold is being accumulated strategically. I want to be crystal clear about this. This is not your average retail investor speculating on a whim. This is not day traders jumping in and out. This is institutional and sovereign behavior. We're talking about central banks, massive funds, and entities that plan not in terms of quarters or years, but in decades. They are methodically positioning themselves for a future where currency debasement continues, and confidence in traditional paper assets, like bonds and even certain stocks, begins to seriously erode. They aren't buying gold because it's flashy. They're buying it as a foundational asset, a bedrock for their portfolios in uncertain times. This is a slow, powerful, underlying current that is steadily building momentum. Now, where does silver fit into this picture? Silver is the high-leverage expression of that very same move. This is because silver's price is a unique cocktail of three powerful drivers, all mixing at once. But there's another piece to this mechanical puzzle that most people completely overlook, and it might be the most critical factor of all: free float. Free float matters infinitely more than the total theoretical supply of silver in the world. People hear about massive amounts of silver being mined or existing above ground, and they assume it's all available for purchase. That is a dangerous misconception. It's in jewelry tucked away in drawers for generations. It's in the hands of long-term holders who have no intention of selling unless the price reaches truly life-changing levels. The silver that actually matters for price discovery is the tiny fraction that is available for immediate purchase at current market prices. This is what we call the free float. It's the inventory held by dealers, the registered stock in commodity exchange vaults. It's being steadily drawn down by the consistent physical demand we've been seeing. A piece of news, a shift in market sentiment, or a major player entering the market can cause a tidal wave of buy orders to hit all at once. But supply cannot respond quickly. You can't just flip a switch and produce more silver. Opening new mines takes years, even decades, and billions of dollars. Recycling is slow and expensive. So, the supply is what economists call inelastic. It doesn't stretch easily, and when elastic, fast-moving demand collides head-on with inelastic, slow-moving supply, the only variable that can give is the price. And it doesn't just edge up. It must reprice rapidly and violently to the upside to find a new equilibrium. So, how does this sequence actually play out in the real world? Here's the likely chain of events based on these mechanics. First, the foundational move. Gold continues its steady, determined climb higher. It will break through key psychological and technical levels, signaling to the wider market that its bull run is confirmed and has legs. This is the starting gun. As gold validates the move, silver begins to stir. It will start by breaking through its own major resistance levels. These are price points where it has failed multiple times in the past. But this time, fueled by gold's strength, it pushes through. This is the moment that triggers the second phase, acceleration. As silver breaks out, short sellers, those who bet on the price going down, will be caught in a trap. They will face mounting losses and be forced to buy back their positions to close them out. This forced buying creates a feedback loop, pushing the price even higher, even faster. This is what's known as a short squeeze, and in a tight market like silver, it can be absolutely brutal. As the price accelerates, something fascinating happens to the supply side. Liquidity, the ease of buying and selling, begins to dry up. Why? Because the few sellers who are left see the rocket launching and decide to pull their offers. They think, why sell today for 50 when I might be able to sell next week for 70? They will simply wait for much higher prices, which removes even more available silver from the market, making the squeeze even tighter. At this point, the machines take over. Algorithmic trading systems, which control a huge portion of market volume, are programmed to chase momentum. They will detect the massive upward velocity and automatically jump on board, adding enormous buy pressure and pushing the price into a near vertical ascent. And only then, after the move is well underway, do the headlines ignite. The mainstream financial news will start blaring stories about the unprecedented silver rally. This is when the final wave of participants arrives. The retail public, they come in late to the party, chasing the performance they see on the news. By the time all these forces converge, a price target like $100 an ounce is no longer a point of resistance. It's not a ceiling. It becomes a magnet, a psychological landmark that the market feels compelled to touch and even overshoot. The momentum becomes a self-fulfilling prophecy. But here is the critical warning that most people will miss in the euphoria of the moment. Silver tops are not gentle, orderly affairs. They are chaotic, violent, and specifically designed to inflict maximum financial pain. A typical silver peak involves breathtakingly sharp spikes that seem to defy gravity, followed by deceptive, terrifying pullbacks that shake out weak hands. That final surge is engineered to trap the last of the late buyers, the FOMO crowd who believe the price can never go down. And once the large institutional players have finished distributing their holdings to this final wave of euphoric buyers, the collapse happens. Silver can fall just as fast, if not faster, than it rose. The elevator up can become a free fall down with no parachute. Let me be very clear about the risk here. Missing the entire move is painful. Yes, you'll feel regret, but it's survivable. Your capital remains intact. What is not survivable is riding the rocket ship up without a plan and without discipline, refusing to take profits off the table because you've become convinced that it can't possibly reverse is how fortunes are lost and confidence is completely destroyed for a generation. You have to understand the nature of this beast. Silver does not walk or jog to its price targets. It doesn't take the stairs, it teleports. The move, when it comes, will likely be faster and more violent than almost anyone can imagine. The opportunity for generational wealth and the risk of catastrophic loss are inseparable. They are two sides of the exact same coin. So, when you strip away all the noise, the predictions, and the emotion, it all boils down to one simple, mechanical reality. The setup is in place. The gears are interlocking. The only real question left is whether you are prepared for the speed. Thanks for watching. If you found this analysis valuable, be sure to subscribe for more updates.